2027. That's how long Bank of America says you'll be waiting for a Fed rate cut. And some analysts are now saying the next move isn't a cut at all, it's a hike. Most investors have no idea this just landed. Here's what's really going on and what you need to be thinking about right now. Bank of America just dropped a bombshell. No Fed rate cuts until the second half of 2027. Not this year, not next year, 2027. Today's CPI print rattled Wall Street hard. Inflation is not cooperating. The Fed's justification to ease is evaporating in real time. NASDAQ and S&P 500 futures are moving lower right now as traders reprice the entire rate cut narrative. This isn't a small adjustment. This is a fundamental shift. Bond markets are feeling the pain immediately. Duration risk, the sensitivity of long-dated bonds to rate changes, is now a live grenade in millions of portfolios. High multiple growth stocks, companies trading at 40, 50, 60 times earnings, are built on the assumption that cheap money is coming back. That assumption is now crumbling. Cash is quietly becoming one of the most competitive assets in the room. Short-duration instruments are suddenly looking very smart heading into late 2026. But here's what nobody is saying about this yet, and this is the part that should actually alarm you. The conversation has shifted from when the Fed cuts to whether the Fed hikes. That's not a semantic difference. That is a completely different investing environment. A rate hike in 2026 would be the Fed admitting that inflation never truly came under control, and that the rate cut pivot the market spent 2 years pricing in was a mirage. Equity valuations, credit spreads, mortgage rates, corporate refinancing costs, everything gets repriced simultaneously. The last time markets faced an unexpected tightening cycle that nobody saw coming, it was 2022. The S&P 500 fell 19.4% that year. The NASDAQ dropped 33%. History doesn't repeat exactly, but it rhymes loudly. First, examine your duration exposure right now. Long-dated treasury bonds and bond funds face significant mark-to-market losses if rates stay elevated or rise further. That's not an opinion, that's math. Second, stress test your high multiple growth positions. Ask yourself, does this valuation hold if the 10-year yield stays above 4.5% through 2027? If the answer makes you uncomfortable, that's data. Third, reconsider what safe means in this environment. Short-duration assets, cash equivalents, and floating-rate instruments are generating real yield right now. In a higher-for-longer world, that matters more than it has in 15 years. 2027 for cuts, possibly a hike before that. The Fed's next move may be nothing like what the market expected. What does this mean for your portfolio? Drop it below. I read every single one. This video is for educational purposes only, not financial advice. Always consult a qualified advisor before making any investment decisions.